You're listening to the RE Social Podcast with your hosts, Andrew and Vince from AnVi Invest. For more information, go to anviinvest.com.
Ladies and gentlemen, welcome to another episode of the RE Social Podcast. Today we have a very special guest who I've met through another guest that we had, Mr. Christian White. Today we get to speak with the very brilliant Nicholas Pardini, who is going to go ahead and just give us a quick, brief intro of yourself and what you do.
My name is Nicholas Pardini. I am a partner at a wealth management firm, Spearhead Advisors, based here in Newport Beach, California. We provide investment management services to high net worth individuals, small businesses, and those rapidly on their way to becoming high net worth individuals. And prior to that, I worked as an analyst or a portfolio manager at various hedge funds in the West Coast and in Singapore. And I also host a YouTube channel called Analyzing Finance with Nick, where I talk about the big picture things in macroeconomics and finance and why they matter to my viewers.
Yeah, I love that. The YouTube channel, when we had lunch the other day, what was the stats like? It's just recently really started to blow up for you. What was it,
Yeah,
a
we're
couple
at
months
about
ago?
24,200 right now. And like
Nice.
a couple months ago, we were at 2,500.
Yeah, that's wild, dude. So how long did it take to get to, say, the 2,500
Three and a half
subscribers?
years.
3.5 years. And you're
I took the
releasing,
channel seriously like in August of 2021. So
got it. Okay.
I was basically zero at that point. And yeah, from August 21 to basically September 2024, I was at
Wow.
2,500, three
Wow.
years, and then it just kind of took off. There's
And
no overnight success takes years.
yeah. And you were releasing it's a video a week for that long?
Yeah.
Wow, just putting in the reps, man. That's respect. Like I've got a lot of people that ask me for advice on like how to do things and like build a business or whatever. And I would say a lot of them tend to fail in the follow through and to just doing the work and doing the work despite seeing results, which is what you did, man. So I have a tremendous amount of respect for that level of grind and hustle. Not to mention the channel's really good, dude. You're really smart. You can tell that he's kind of got the Graham Stephan thing where you can tell like you kind of like are studying a lot of data points and then just putting it all together and kind of summarizing it for dum-dums like me. So thank you.
You're welcome.
Yeah. Awesome, man. Vince, you got any comments on anything so
Hell
far?
yeah. I'm gonna go crazy on this episode.
Oh, here we
People
go.
are gonna die listening to this. Two nerds, nerd fest. Hey, so I wanted to start off from the top. So you said you manage for high net worth individuals. So if I make six figures, am I considered high net worth?
It's more of an assets you have liquid
I
versus
see.
like income. But the higher income people who may not have the assets, especially if you're under, say, 50 years old and you're saving
Mm-hmm.
$3,000+ a month and are rapidly growing your savings, that's those are clients we work with because they will become the multimillionaires in 5 to 10 years.
I see. So what do I have to come to you or your company to work with you?
Yeah,
Right.
our general minimums are 500,000,
Okay.
but we waive them for people under certain circumstances who we think are going to be growing their accounts a lot and could benefit from what we're doing.
So let's say I have $500,000 in cash. I come to you. What kind of services do you guys provide? Do you guys buy bonds and stuff, or do you guys buy stocks, or how does that work?
We do bonds, stocks. Uh, if it makes sense, we use options for hedging and basically anything that's publicly traded.
I see. Okay. And what kind of fees do you guys usually do? Is it depends on the client, or is it
Yeah,
the
it
same?
depends on the amount of assets. It's like the reverse of tax brackets. It
Okay.
starts at 1% for the first million, and then it goes down for larger
Nice.
accounts.
Yeah, that makes
How low
sense.
does it go if you have like two, three, four, 5 million? Does it
The
goes?
lowest we probably go is like 500,000 for those about 10 million and above.
No, no, no. The management fee.
Yeah, the percentage.
Yeah, the lowest percentage is a 0.5% for
Oh,
people over
half a
Oh,
10
percent.
million.
Okay,
oh,
that's
you
good.
said half a
Above,
million. Okay.
Okay.
Yeah,
no,
yeah.
no, 0.5% over
Ah,
accounts over 10 million.
Okay,
cool, cool.
that's cool. We don't do much stocks. We got, maybe six figures in it, not too much, but Now, what would make sense for someone who has 500,000 to come to you to do some work on it rather than just buying like, Vanguard index fund for like 0.05% or something?
Yeah, for smaller account sizes, like it generally does make sense maybe to go in index, but
Yeah.
the problem with indexes is that I think that they're not constructed very well.
Sure.
At least given what I think for the macro environment, they're cap weighted, and because they're cap weighted large cap, and with the concentration of returns in big technology companies, it's 25 to 30%. The S&P is 5 to 7 big tech companies. And if those have a downswing, even if the rest of the market goes up, your returns will not be very good.
Mm,
And they're also, depending on your risk tolerance and a variety of other variables, uh, there are other asset classes that it makes sense to be in. And the idea you hear a lot is 85% of fund managers underperform the S&P.
yeah.
That is true, but it's not entirely representative just because you're only comparing large cap mutual fund managers to a large cap index. If you look at other asset classes such as bonds, small cap stocks, international stocks, uh, etc., it doesn't the active managers don't look nearly as bad. And
Interesting.
and for years, a lot of people are underexposed to some of these other asset classes. With interest rates as high as they are, bonds are attractive for the first time in my career, really, over the past 2 years. Prior to that, when the Fed was holding rates at zero, bonds didn't really make sense for people. Now you can get almost equity-like returns with some high-quality bonds, and uh, that makes it more attractive than it used to be. The other thing too is that due to how strong the US dollar has been and how much capital flow has been concentrated in US technology companies, a lot of international equities are relatively undervalued right now. And even on the real estate side, it's probably for you guys to be interested. International real estate, due to currencies and perceived political risk, seems to be relatively undervalued compared to US or other English speaking country real estate. And then and then small caps have been largely discounted. And the small cap index is constructed in a way like if you're one of the worst of the large cap companies and your stock price goes down, you get kicked down into the small cap index. Whereas if you're one of the best small cap stocks, you get promoted up into the larger cap indexes. So that's why um, active management tends to work better for smaller cap investing because of the way that the indexes are constructed.
Wow. A lot to uh, pick and peel out of that. Real quick, just for the audience, Nick, what's the difference between small cap and large cap?
That's just the market capitalization is the size of a company. So you multiply the number of shares times the stock price. That's what a market cap is. And small cap is generally companies that are, I mean, it depends on your definition. People say like it's generally smaller than $5 billion in value. Um, Mid caps are anywhere from 2 to say $10 billion in value, and companies above $10 billion in value tend to be large caps.
Got it.
So that's
Didn't
kind
know
of
that
the
myself.
why.
Okay, nice. Vince, you want to pull anything out of that?
Yeah. I was just listening in to see. So people who are making, they don't have the time and they have millions of dollars, you kind of come take them over and start to see where you can move the money to kind of in a way to beat
Yeah,
the market. And is that something that is
not purely just to beat the market, it's to help them get the best we try to get them the best risk adjusted returns based on what their goals are.
Right. And the risk tolerance, of course. Yeah.
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 So
What are some of those interview questions that whenever you bring in, like, so for us, when we are going to coach somebody, or yeah, no, we don't even partner with anybody until we've really got to know them. So when we coach somebody, we have a whole questionnaire to make sure it even
yeah,
makes
we
sense.
have a risk tolerance and financial profile questionnaire that we have prospective clients fill out.
Mm,
And it tells us like it's kind of like the financial equivalent of like your medical history.
yeah.
And
Got
people
it.
just so they know where they stand and
Mhm.
what inflows and outflows and that they have and need to be accounted for in future expenses or future windfalls.
Right.
And then you have the other side of it, which is the risk tolerance, where we use this survey, which helps measure people's like lizard brain reaction to
Mm,
how would they feel if a market moved down or their portfolio moved down by a certain amount. And the thing is that a lot of people tend to overestimate their risk tolerance. A lot of people
mm,
say, yeah, I can handle the losses, but then when you have a bear market, they're
mm-hmm,
panicking.
mm. That's interesting. Yeah, I think you were telling me about that. You kind of have some interesting questions that really dig in a little deeper, like you said, to access the lizard brain, which I think is brilliant because a lot of thought, a lot of our belief systems, a lot of even traumas that we all still harbor in some way are buried deep in the subconscious, which is really the decision makers. That's brilliant that you go on that extra step. You don't have to answer this, but what are some of those maybe key questions? Can you share like one key question where it's like it really helps filter out if it's a good fit or not?
But on the risk tolerance side,
Sure.
um, I mean, really just the key question really, it's really just, again, you just give them a hypothetical scenario. Like if the market goes down X amount, will you feel comfortable with that kind of loss? Or if it goes up by a certain amount, how much better do you feel than if it goes down the same amount? And usually,
Yeah.
because of loss aversion, people feel a lot worse if their portfolio goes down 10% than satisfied if it goes up.
Yeah.
And
Totally.
the gap in that spread is what I try to measure. Like some
Mm,
people value like a 2 to 1 margin. Like they need to gain 2% for every
mm,
1% they lose
mm-hmm,
to feel satisfied in terms of risk,
mm-hmm.
whereas others have a different risk reward mentality.
Got it.
And the other thing I asked too is like, really on retirement timelines. That's the other
Oh,
thing.
yeah.
Like if
Totally.
you, that's the more the most important question. Like if you plan on like retiring, or if you're somebody say sold his or her business and you plan on living off of this and you don't want to take a break before your next step, even if you're young, you shouldn't take the same kind of risk as somebody who's working every day and funding
Yeah.
their account. That's the biggest difference. Are you a
Totally.
net funder or are
Yeah.
you a net or are you a net withdraw
That's great.
or like of your account? Because that is, even if your risk tolerance is the same with those two clients, it's a very different
Yeah.
investment allocation strategy.
Yeah, that's great. So it's very like particular to each individual client.
Yeah.
That's the
And
only
also,
way to
what
really
else do you
build a
have?
business.
That's the other one. Like if you have a lot of real estate, for example, and
Hmm.
you're managing for me, what I'm managing for you is like 5% of your net worth.
Hmm.
I'm gonna treat it a little differently than if your
It's
stocks
like
are 90% of
95.
your net
Yeah, yeah,
worth.
totally. Okay. That's awesome, man.
Yeah, we have what, 10% for net worth in stocks, something
Yep.
like
That's about it. Yeah, about 10% of my net worth in stocks right now. For me, I'm like index funds. I love like the easy set it, forget it. I got automated. So my lizard brain doesn't kick in when things go up or down. And I'm like, oh, well, so Trump just got elected and Tesla did this. And I had a conversation. Someone was like, oh, I wish I would have gotten a Tesla. And like, I'm like, see, that's exactly why I do what I do. It's like, yeah, okay, you could argue you would have had a nice little, uh, you know, perk right there. But for me, that's exactly why I don't do anything. I
Yeah,
don't
the
want to get
implicit bet you're
emotional.
making is that U.S. large cap equities will
Hmm.
always outperform everything else,
Mm,
which it has worked pretty well since 2009. I'm not going to
hmm.
deny that,
Hmm.
but I don't know if that will always be the case.
Sure. Yeah, so for me, I remember reading enough stock books to realize I'm not that guy. You are definitely that guy. But I mean, one chapter into a Warren Buffett book, and I was like, cool, this is definitely not my turf. So I knew, and I really self-analyzed, and I was like, I got a good conversation with his buddy, actually, who's very good with that stuff, coached me through how to set it up, got it going, got the Roth, got a little thing and it's great and it just grows passively. And the reason why I like it is because my big focus is real estate. It's something that I can control, I can touch, that I know, and that I can grow. However, I think in our lunch, you had mentioned that you are really not a big real estate guy at all. I'd love to kind of crack that open and find out
Yeah,
why.
it's not my personal habit. I mean, my mother's side of the
Mm.
family has been really into real estate.
Oh, okay.
Some of them lost a bunch of money in the '08 crisis, so that might have kind of skewed my personal beliefs somewhat. But the main issue I'm not talking about from the merits of investing. I'm just talking about why personality wise I do not like it, is I like liquidity. Like
Mm.
if I'm wrong in the stock market, I could sell my stock the next day
Yeah.
and just or just get out and be like reassess it before and I could get back in if I change my mind again.
Right.
Whereas with real estate, if I make a bad investment, I'm stuck in it. and
Totally.
I can't really, and I could potentially lose my shirt because most real estate people are heavily levered. And if it's
Yeah.
unlevered, the returns aren't so great. Like they're not much better than bonds. So,
Gotcha.
like,
Interesting.
that's why I think real estate is very attractive to people because it's the cheapest form of leverage you can get in the
Yeah.
market.
I
Like,
see what
who
you're
else
saying.
can you borrow for 30 years at 7%
Yeah.
and an LTV of 80% or more?
Yep. That's
You
exactly
can't
why
do
we
that
do
in
it.
stocks.
Yes, exactly.
You can't do
Yeah.
that when you're buying a company generally in the private markets either.
Right.
So that's what I think why there's money to be made in real estate. Uh, and also, I think that a lot of and also I have economic concerns about real estate in the long run. But I understand, like, even as somebody skeptical as real estate as I am, as my business grows, I probably will put 25% of my personal assets in it.
Okay.
I just
Nice.
probably have a different ratio than you, but I still
Yeah.
think it has a place, just not as big of a.
Okay. Got it. Yeah. And that makes sense when someone like you is like very well studied and knows stocks, and it's literally your job and your company. That makes total sense. Yeah. And then whenever you want to get that, 25% going, you know who to call. You got to call us.
Yeah.
And vice versa. Vince, did you have any comments on that?
Yeah, Nick. So I was just writing down some stuff you were saying just to see, the conversation. So you were saying that, with stocks, if you make a mistake and then, you can pull the money out, real estate is kind of stuck, till you do that. But, if you in stocks, if you make a mistake, you sell it, you just made your unrealized losses into actual losses. Well, so I don't see how that'll be different, right? Than real estate. It's the same.
Well, your unrealized losses can be a lot smaller, and since there's not likely to be margin or debt attached to it,
Mm,
uh,
I see.
it
So you're saying it's
and
like
you
you
can
just see a
also
little bit.
cancel. You can
Cleaner.
also, and also you can use those losses on if if to take profits on your winners and cancel out some of it from a tax basis. But
Mm,
that's not really a reason
yeah.
for
Sure.
it, but it's just more the flexibility. And like, say for example, you bought a property in a city that's booming due to a
Sure.
particular industry,
Yeah.
and I bought a stock in a company in that booming industry.
Hmm.
And I'm starting to see the signs that like it might have maxed out. I can sell my stock the next day if my fundamental view on the industry is driving it. Whereas with real estate, you might not be able to.
Right.
Yeah, it's true.
Yep.
The
I like
market can
that.
get locked.
It's an interesting scenario. Yeah.
Yeah.
This is great.
Yeah, it's funny like how different people have different things. That's actually the reason I like real estate because if Drew wants to go buy a Benz car tomorrow, he can't because his money is locked for like 30 years, right?
Strapped.
It's not really 30 years, but still it'll take time to pull it out. So I like the liquid
Well,
access.
something that he doesn't know is I just tore down a wall in one of our duplexes and sold it on the black market, and I'm
Yeah.
getting a Benz tomorrow.
Hell yeah, dude. You
Yeah.
sold it as two houses.
And
Equity
then
is
the other thing I
untrapped.
like about the investment stock market for personally is that most of the work is analytical research that I
Yeah.
have to do. I
What
don't
is?
have to go down and physically like
Mm,
tear down a wall or
right.
have to deal with tenants who refuse to pay their rent
Sure.
or have to file unlawful detainers to evict people or
Yeah.
any of the other headaches
Yep.
Yeah.
that are
Yep.
Definitely a
involved. Like
problem.
Great
they're
argument. Yes. I have no response to that because we've lost a lot of money just due to squatters alone. We've got a couple episodes on that in case anyone's listening.
yeah,
So,
and a
yeah.
lot of the political and regulatory things you probably have to deal with.
Yep.
I mean, there are things in terms of managing a wealth management business you have to deal with on that side, and that's why we
Sure.
have a compliance team.
Sure.
But it's not it's but in terms of the actual investment process, it's a lot simpler in that way. And there are ways you can invest in real estate in the stock market via REITs. And
Can
that
you
might be a good proxy. Like if you can't get a yield better than a REIT in the with physical real estate, then maybe you're overpaying for it.
can you remind me what a REIT is? I
It's
think I
a
know what
real
it is, but
estate investment trust. Basically, like it's a pooled vehicle where that's publicly traded, a company that will buy a large apartment building or a portfolio of large apartment buildings or office buildings or industrial real estate. There's REITs for a lot of different types of properties. Some of them are a mix of all these things. And
mm,
instead of, since it's like, if you wanted to buy, say, for example, I don't know, the Irvine Spectrum from the Irvine Company, and it's going to cost billions of dollars, and one person doesn't have the cash for it. Instead, you can have a REIT, and you have a bunch of people buy fractions of it, and the REIT will buy it, and the REIT is split into shares that are publicly traded. So it's
Got it.
like that. So you're buying effectively like a share of a portfolio.
Got it.
You're probably familiar with LPs and syndications, but it's like that on the mass level and
Got
publicly
it.
traded.
Now, how does that compare to like say a regular just stock, maybe a large cap?
Well, it's they are stocks, but the difference is that there's certain rules. Like REITs have to pay out a minimum percentage of their profits and dividends.
Gotcha. Okay.
So they can't really retain earnings.
So it's a forced dividends. Interesting. Okay.
Yeah,
Yeah, I'm totally just picking your brain because I actually don't even know.
that's
I
one of the
think I
main
studied REITs at one point, but I just forgot everything. So
yeah, that's one of the main differences between a
cool.
regular stock. But otherwise, they function similar to stocks. And
Yeah,
they
so
have to have a rule. They only can be used to buy real estate.
Got it.
yeah, let's talk about the REIT stuff a little bit. So people
Sure.
who are listening, people might think that, instead of buying real estate, I'll just buy REITs. Everybody listening, REITs is not real estate. You get none of the tax benefits. It's basically a share of something some other guy is doing. So he could just go bankrupt and you will make nothing. There's no liquidation sale that you're getting money from and stuff. There might be rules for it, but it's not direct ownership. So what we like to talk about on this stuff is we want to get closer to the gold or the coal or the mine, right? You go more and more away from it by buying paper and like stocks. And I'm going to buy derivatives of stock. Now I'm going to buy gold paper. And now I'm going to buy REIT.
Yeah.
What happens is you're going to be the last guy who gets paid out. So when he was talking about when you have a syndication, right? So let's talk about real estate syndication. You're going to have a general partner, which I am in one.
Yep.
And then you have limited partner. Let's say it's your mom, my
Right.
sister.
Own passive.
And then we have the debt, right?
Right.
Who's getting paid out first if the property goes to shit? Or who's losing their money first?
Whoever has first option. So
The debt
I'm going to
payer.
guess the
No, the debt payer will be the guy who gets paid out first. He will
Yeah.
never lose the money. So
Yeah, the lender gets paid out first.
yeah, so
Like
the
bankruptcy.
lender will be the most safe.
Okay.
So, but that's the debt, right? So then he is safe from most of the stuff. So let's say you're raising capital, it's a 55% levered, right? That means you have 45% equity. So the property goes down by 45% and then you have to sell it. The lender keeps all his money.
Got it.
The first guy who loses is the GP. The second guy who loses will be the LP.
Okay.
And then the last person will be the lender. So that's a very safe position. So when as you keep moving away further and further away from that, you get more risque, I would say. So for like REIT, I wouldn't consider that any investment because you don't get any tax benefits. You can't write off anything. You cannot write off your home office or your mortgage interest. Nothing. There's no cost segregation study you can do.
So the big thing is the tax advantage.
There's no tax benefits of REIT.
That's your big. Okay, that's the big.
Plus,
Yeah,
there's no
see, he's
leverage
correct
play.
on that because
Yeah.
you were running your real estate as a private business.
Yeah.
Like whereas you owning a share of a REIT, you are the LP. It's like being an LP. LPs don't like that's the. I mean, it's not quite the same.
Yeah.
But like that's that's kind of that's the closest thing I would compare it to on the capital structure.
Got it.
Yeah. And the thing is though, with when it comes to REITs too, is that the other main thing drawback for REITs is that you do face volatility. So like if you can't lever REITs like you can real estate. And so like you can in theory, let's say you bought a REIT with 4-to-1 leverage, like you buy a house.
Yeah.
If you go down 20%, you'll be forced out in a margin call. Whereas if you have negative equity, you're not necessarily forced out as long as you pay that mortgage.
Right. Right.
And
Interesting.
I mean, I'm just trying to present both sides. I think the advantage of REITs is flexibility and liquidity, and what you get paid is net of everything, net of the expenses, net of any property taxes or all that stuff, and you don't really and any property management fees or any of the other expenses you incur directly. And I think what you guys are saying is you're talking more about running real estate, buying real estate as a business owner and being a professional real estate investment and property management firm, whereas I'm looking at it just from more an outside. A REIT investor is more looking at it as an outside investor who doesn't want to actually run and manage a business. They probably have their own business that they could get business owner tax break that instead.
Interesting.
No, we're still talking about the similar stuff. Yeah, the one will be the guy who's syndicator, right? That'll be like us, let's say. We actually don't do syndications. We just do tenants in common. But let's say you do invest with us, right? For example, in we actually give 60% of the property direct ownership to the guys who are giving us money. So you do get direct ownership and you get all the tax benefits without doing some of the work. Then that's kind of like what a lot of people do, real estate. So I see, a lot more benefits with that. So how would you combat like stuff like, for example, like you mentioned, leverage? There's always leverage in real estate. We lever, 4 to 1, whatever. We put down only a quarter, and then you're getting more for your money. And if I just hold on to the property, right? So I'm getting 4 times more return because I'm only putting 1/4 the capital. So even if it's at 3%, I'm getting 12%. So how do you combat that with just doing stocks that is basically 1 to 1, right?
Yeah, like there are riskier hedge funds who will way go up to 2 to 1, but that's
Mm-hmm.
not what I do. I don't really do leverage personally.
Yeah,
Yeah, I mean, the thing is that a lot of the companies' balance sheets that you're buying have operating leverage in them or
that's
financial
true.
leverage.
Yeah,
So, like that's how there's some returns that come from that, assuming the company has a positive return on equity or
sure.
a return on equity that's higher than their cost of capital. But yeah, I mean, you're just again, that's a higher risk, higher reward investment. Like there's the capital price. Are you guys familiar with CAPM, capital
No,
asset
No.
price
what is that?
model? It's the idea that there's a curve that between risk and return that like the higher risk you take, the more returns you
Sure.
get.
Mm.
And
Yeah.
there's like in theory, it's a theoretical line because it's not necessarily not every dot fits on it, but there's a
Sure.
theoretical curve that given how much risk you take, there's a certain expected return. And what you guys are doing are farther up the risk curve than what I'm doing.
It makes
And
sense.
that accounts for the difference. Like if you are
Yep.
getting higher returns with higher leverage, you're inherently taking higher risk.
Yeah.
But what if, if somebody said, okay, that is true, real estate, the tenants might not pay and then you're screwed, right? But what if we said, well, we are the guys who are putting the tenants in and we control the area where we're buying what property it is and stuff. And there's no insider trading. Whereas you're just buying Microsoft stock and Bill Gates could be caught up in a fraud and he goes to jail and they go to zero and you just lost all the money. So what happens there? Because you really don't have any control, right? With all
Yeah,
these CEOs.
those are systematic and idiosyncratic risk.
Yeah.
Yeah.
There's like there's different risks.
Yeah.
Like there's certain risks that are more in the equity market and buying single stocks versus an index,
Yeah.
and then and investors are to have higher expected returns for buying a single stock versus buying the index for that
The
very
index fund.
reason. Like
Yeah.
I'm not going to invest in a stock that I'm not going to hit that I don't believe will hit a certain return target.
Mm-hmm.
Like if it's a stock that has an expected return of 5%, uh, and the risk is say like the downside standard deviation is way more than that in a given year, um, and I'm not going to necessarily make that investment. So that's part of the security selection process that you have to go and find the things that have a positive risk, like a positive risk reward. Like that's part of just what I have to do as every day researching possible companies. Like part of my business is just turning a bunch of stones and not finding anything under them. Like
Yeah.
and Warren Buffett's famous saying, "There's no called strikes in investing.
There's no what?
They're
Sorry.
called strikes."
Oh,
Like when you're
yeah.
playing
Interesting.
baseball,
Yeah.
if somebody throws the strike zone 3 times, you're
Yep.
out.
Yep.
But they don't really have that in our
Yep.
business. So yeah,
It's kind of similar to what we do when we're, looking for
that's part of
deals.
discipline is to find the things that are going to give you.
Yeah. Yeah.
Yeah,
It's very
very
similar to
similar.
what we're doing with our guy, this guy Bruce that we coach, who's closing next week, which is awesome, in the Denver area. He had thrown it. How many deals did he toss our way? Like
Yeah. We touched it. 4 deals.
about 4 deals where we just, we looked at him and we're like, hey, bro, this is not going to work out for
No, we
whatever
we
reason.
tossed 4 deals that he went into escrow and then he pulled out. We looked at
Oh,
probably 100 deals.
yeah. So lots of stones basically that we're turning over to analyze and say, nope, 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 a lot of no's. And finally we get after about 100 or so, probably more. He went to escrow a couple times before, or he at least made an
Three,
offer.
three. No, we were in escrow.
Yeah. So he's just been like, we've been helping him to analyze what's happening underneath that stone, which is what we do. And so it's very similar. It's just hard to find the opportunity and it's hard to find stuff that's worth the risk because you're right. It is inherently risky. And that's why what we do is what we do. because we've taken enough risks where we've gotten burned on it. And thankfully, we've got high paying jobs. So we were able to sustain through some of those mistakes. Be it, the area wasn't great, tenants stayed past their lease, and, then it's in whole, like you said, you're getting the lawyers involved. So yeah, there's inherent risk in everything. For me, I like that I can get smarter with it, that I can go touch it. I'm like an old school Kansas guy. Like I've been mowing
Yeah.
lawns since I was 5. Like I like that I can go repair it if like everyone just disappears. Like I will just go drive and just go do it myself, which I have done before. As a real estate agent, I've gone up and shown a couple of our duplexes before up in the Redlands area, so
Yeah, I mean that's kind of again, you're gaining alpha, which we call in the world like return above expected risk
yeah,
by being willing to do that kind of thing.
yeah, yeah,
Like if your average investor probably is not willing to do that. They're not willing to
totally.
fix a property themselves or get a real estate license or anything like that. And
Right.
so that's a big difference.
Yeah. And so with you, what would you do in terms of real estate if you were looking to invest yourself? Since you're more of a stocks guy, you said you wanted maybe 25% is your ideal. What does that look like for you? What do you see yourself doing?
Yeah, I mean, what I would do is I would try to. There's a few things. I've considered being an LP in some sort of syndications,
Mm,
and like just help finding people who are better at finding these deals than me,
yeah. Smart.
and like managing it for me. Um, the other thing is that I would maybe do analysis just from my macro view. What are the cities
Of course.
or the places that I think have upside and have favorable caps? I kind of look at investing in real estate personally more for a cash flow basis than appreciation. If I was going to get involved in it, I'd want to try to find things that give a solid cash flow. But if there's a major fundamental change, I could get upside appreciation, but I don't really want to bet that as part of my assumption.
Got it.
I want to think of that just kind of as a bonus.
Appreciation as a bonus.
Yeah.
Got
Like,
it.
of course, I'd love to find things that I expect to appreciate. I don't want to go in a market where I expect to go down,
Yeah. Yeah, of course.
but like at the same time, like even if the market goes nowhere, I want to still win on the
Yep.
deal.
I got it. So you want that cash flow guaranteed.
Yeah.
Interesting.
Hey Nick, I wanted to ask about some of the stuff we talked earlier, which is, and also, trading stocks and, doing bonds, which are all public uh, knowledge, right? So there's
Yeah.
not like a deal that you could get. So you would have to research like, I don't know how many hours, you just constantly trying to find stuff that other people would miss, right? So I don't like that already because that is just like because so if you look at the numbers on returns for the last 100 years,
You're assuming that the market's efficient though with that
yes,
conversation. Like there's plenty of non-economic reasons why people will buy and sell stocks that create distorted valuations, and
yeah.
that's where the opportunities are created.
Hmm.
Yeah, I mean, there's different things, you can look at PE ratios and all that stuff. Sometimes it's super, you could have said, oh, Tesla is really whacked, but it kept going. I don't know, maybe some people would have bought it and be like, well, actually, I like what Elon Musk is thinking, all that stuff. But what I wanted to talk about is if you look at general public markets, you're kind of like, you see the information and you kind of try to understand. Otherwise, you will be caught for insider trading. But where I see the returns, if you look at a long period of time, is it's going on to private equities where people have ownership in a business or whatever it is, right? So what do you say to that kind of investing? Because
What for
that's where
private
the
equity
return,
versus public equities?
yeah, like you can't buy stock in my company, but I can just buy
Yeah,
a
I mean,
property.
historically, you should get a higher return. In the past, you should get a higher return for private equity because you are taking the liquidity risk. Investors should be
Yeah,
compensated by the fact they can't get in and out easier.
Yeah.
yeah,
However, in recent years, you've seen the opposite, where a lot of institutional investors like the idea that they don't have to mark to market and they can show a smooth return profile. Even in reality, it's more choppy, but they don't have to because the market doesn't trade every day. They don't really have to show the gyrations as much. And so
Yeah.
you can present a much perceived, not necessarily lower risk, but a perceived lower volatility investment. And that appeals to allocators. And therefore, they're now willing to pay a premium for private versus public. And that's why I think private equity uh, is at a major risk of underperforming
Mm.
public equities for the next decade.
Have you thought about investing in real estate and taking advantage of all of those benefits without any of the work? That is something that AnVi Invest not only provides, but has been providing since its inception. With friends and family, we have built an empire in a system of a wealth generating tool that is giving us and our friends and family that leverage in their life to create true wealth. Go to onvinvest.com for more to see if you qualify. And thanks for listening. So, real quick, you said you'd be passive. So it sounds to me like your big thing is you're like just building your business. That's your biggest asset that you're
Yeah,
building, right?
like you guys are putting your real estate is your business.
Yes.
You're putting your that so that's why it makes sense for you to put most of your time and energy into that. That's why I work on my clients do. You're not gonna get rich by having a stock portfolio
Right.
or a real estate portfolio passively. You're gonna
Yeah.
get rich doing your career.
Yep.
And it's my job to help you your returns, like help your investments so that you stay rich.
I like that.
Like
Okay.
or that you don't lose too much to inflation. Like that's what I try to do.
Right.
Like it's not about like I'm not trying out there to hit home runs necessarily.
Yeah.
And I'm trying to invest for my clients in a 3 to 5 year time frame, not looking for short term like trades.
Interesting. Yeah.
And
And
so like that's why and for me, my business is building my company. That's how I'm going to get wealthy and successful
yep.
is by building a successful business. I just happen to be in the investment management business because that's lines up with my aptitude and my interest. Uh, and it seems like that's the case with you guys in real estate.
Yeah. For us, I kind of want to go just real quick into the nerdy stuff. We read a lot of books before even like starting to execute on this stuff. Still made a lot of mistakes, to be very clear. What are some of the key things that you did to educate yourself to get to this place where you can run a company at this level? Like,
Yeah.
are there books? Are there mentors? What was some of the big stepping stones that were
Yeah.
required?
I had several mentors.
Mm,
Actually, my first mentor was my grandmother when I
nice,
was in my um, preteens and teenage years. She taught me the basics of stocks.
nice.
And a lot, but then when I went to college, I did an apprenticeship under a hedge fund manager who ran his own family office where I learned the more advanced things. And there's several books you can read. There's actually, I have a reading list that if you join my Substack, you get an email that will be able to download the PDF with the top 100 books that I've read about finance, macroeconomics, and other related topics. So if you want a place to start in terms of a reading list, that's a good way to place to get it. I can't really list them all here because it's like 100 books, literally.
Where do I find that? It's like a link I can
Just
visit?
join my Substack. It's nickpardini.substack.com. It's called Nick's Present Value.
Okay, dope. Okay,
And
absolutely.
then that's where you can get the reading list. I read hundreds of books about investing and
Nice.
several reports and pamphlets, and I worked several years in the industry professionally too, and that's how I
Right.
learned. And
Got
the
it.
other thing, it's like with you guys, you can read all you want, but you don't truly learn it
Yep.
until you actually
Yeah.
do it.
Get in the
Like
ring.
like paper trading on Simu stock or is great, but when you actually go out there and do something and you see your P&L move down or up, more likely down is when you learn. That's
Yep.
like the joke in the industry. When you have a losing trade, that's called paying tuition.
Ha, I like
Yeah.
that. Yeah.
So that's where that you learn by doing as well. So
Yeah.
it's kind of a mix of everything. And then
Yep.
the CFA program, I took the exams for that, and the level one curriculum was a good way to kind of learn the basics.
What is CFA?
Chartered financial analyst.
Nice. Vince, any
Yeah, I
comments?
have one more kind of question that I want to talk about. Like, like if, people don't have $500,000 in cash to invest with you, what are the things that they can, learn from you, like what you've done? But before that, I want to hit up, you mentioned something about international markets, and have you seen a difference in performance in that? Because you mentioned as though it is better than US markets.
International markets had lagged the S&P from say 2009 to 2022.
Yeah.
And I mean, I can look, let me just give me a second. I can look up like what the returns have done in recent years, but I think they're in line with a slight advantage to international stocks that since then. Well, actually, no, international stocks are still
Fairly high.
recently, they still actually have, never mind. They actually still have been underperforming lately. But the thing is that the relative underperformance is where the opportunity is. Because if you look at the valuation gaps and the higher dividend yields of international stocks, the US dollar, a lot of the change has really been just the strength of the US dollar relative to other currencies. So if you currency hedge it, the international stocks have also fared pretty well. Like one of the best investments over the last um, several years has been currency hedged Japanese stocks.
Hmm, interesting.
They
Currency hedge being the key.
you short the yen, um,
Interesting.
and you keep the equity, um, and that since basically the last 3 years has outperformed the S&P by 50%.
Wow.
And with international stocks, you don't necessarily just buy the international basket. Like for certain countries, that makes sense because a lot of the performance is sector driven, and like Europe, they sell to a lot. Even it doesn't really matter what country it's headquartered within Europe, they're selling to all the other European countries anyway. But for other markets, they have different domestic fundamentals, and again, there's the combination of relatively low valuations, higher dividend payouts, the concentration of international indexes being in more diversified sectors versus being overwhelmingly in technology and healthcare, like uh, the US index is. It's going to provide longer term opportunities. And I'm not saying put all your money in international, but I just think you should have a larger allocation to it than the way the indexes allocate to it now.
Yeah,
Nice.
I was looking at I think the S&P 500 is 40% of the world in terms of capitalization for the stock market, which is
I thought it was
insane.
more than that. I
Wow.
thought it was like
Or is it?
60%.
But if you include the US market, I think it's like 50 to 60, all of the US companies. So it's like the
Mm,
US is like more than half of the world's
that's wild to
companies
me.
Yeah,
because we are
it's
very
only
capitalistic.
20%, it's only 20 to 25% of GDP. So,
Yeah.
like that's that gap I expect to fill.
Yeah.
And you've had periods where international has outperformed the US. Say, for example, like from 1990 to 2008,
Sure.
we had the gap that we have now for the S&P International was reversed, especially from 2000 to 2010. So these things are in cycles.
Yeah. Yeah, because my family is from India, and we bought some assets in India over the years, and it has definitely doubled and tripled in the decades that we've owned them. But when you convert it back to US dollars, it's dog shit. It's nothing. It's zero. There's nothing there. So if you buy stuff in other currencies and stuff, and you trade it back to the US, I haven't seen anybody who's beating the US dollar. It's always comes up short. So if you go and invest in other countries and you hope that other currency will do better than the dollar, I think it's a losing bet 10 out of 10 times. It never goes well. So is that different in terms of stock? I don't know how that works.
Well, the stocks are you when you buy an international stock listed on the New York Stock Exchange, it's priced in dollars. So
Oh,
the
that's how you're
currency
getting around
movement,
it.
the
Okay.
currency is showing in the returns. You can buy, there's certain ETFs that will hedge the currency for you, which means they have a short position embedded of the currency into it. And that's a way you can do that. Or if you, but for most countries, they don't have that. There's like Europe and Japan are the only ones I think that have currency hedged ETFs that are easily accessible. Um, if you want to do that yourself, you would have to put a short position on the local currency and then even it out with the stock. But a lot of emerging markets such as India,
Hmm.
you generally the currency is a large part of the returns. So if you're betting on that specific country, you want to you don't want to hedge the currency because the currency and the stock market are positively correlated. They'll go up together.
But it's not though. When I got to the US, it was 40 rupees to a dollar. It's 85 now. So my portfolio doubled in value in India, but is worth nothing to us here.
Yeah, that's India's growth story is kind of unusual in that
Yeah.
case. It's just with like other emerging markets, like for example, like Mexico or
Hmm.
Chile or or Indonesia or things like that, usually they move together. Like, but India is, I know it's been a different story. I've noticed, I've seen the rupee consistently decline and the Indian
Yeah.
stock market move up. But if you look at it, like the Indian stock market still over the past, like since January 2023, has still rallied 26%. And basically was in line with the S&P until about October of this year, where the S&P started to take off and India has been selling off the last 2 months.
Yeah. It's pretty, Nick, I'm starting to think buying real estate is a lot easier than this crap.
Yeah, I'm just sitting here just like taking as many notes as I can, listening to these this
It's
nerd
like
fest.
it's a lot. I'm gonna buy index funds, pay Vanguard
Yeah,
0.04%
yeah.
and just get my stupid 6 to 8% or whatever it is. What does
Yeah.
index funds do, Nick? Is it 8%?
On historically average, it's 7 to 8%. The last 10 years, it's been a lot higher
It's
because we
higher,
haven't
yeah.
had a real bear market. It's
Right.
like low, it's like, I don't know, I think it's 13 or 14% since 2014.
Yeah.
But like, if you look at it from a longer period of time, like basically since the 70s, when say since index funds really became a thing, it's about 7 to 9%.
Yeah.
Gotcha.
Yeah, it's not bad. I mean,
That's before inflation, not
No,
counting inflation.
no, that's not counting inflation. That's just
not
absolute return.
not adjusted for inflation.
Like in theory, the stock market should move up the same rate as nominal GDP
Right. Yeah,
because
that's
it's a
why,
reflection of the
when you
economy.
guys get in the weeds about, the conversion and the rupee and the this, and I'm like, yeah, that's exactly why I threw up my hands years ago and was like, cool. That
I
little red book of investing was all I needed, and I just do that.
I just like to bet on like big things
Like what?
like the US military. Just
Oh, sure.
I just
So you like to win, sir.
I just like to buy stuff where, I mean, what are we like 60% of the world's print the dollars, all the money moving is 60% is us, right? And then
In terms of
20%. Yeah.
reserve currency status, it's probably more than that, but I don't know the exact number off the top of my
I think
head.
it's like 59, 60, and then 20 is like euro. And then the whole world is rest. I'm like, who cares about that? It
Yeah.
just doesn't make sense.
Just
China is like what, 5%?
right.
It's nothing.
Well, China doesn't have like free movement of capital, so that's why you don't need to hold it internationally because it's hard, it's hard to bring it out of the country.
Well,
Mm.
they are communist.
They have a lot of restrictions,
Yeah.
so that's so the Chinese currency also has it's not hard pegged anymore like it used to, but it kind of has a soft peg to the rest of the currencies in the world.
Yeah.
So it's not really a emerging market currency that people really trade unless they're using a lot of leverage.
Yeah.
I'm,
So, yeah. Sorry, you
I
want
was just
to
gonna.
say?
I might be rabbit trailing completely off of a side tangent, but I noticed there's a lot of Chinese buyers here in the U.S. buying up a lot of real estate. And there's this whole talk about, China becoming the next superpower. They're on, pace for that. And yet they had that one child policy for a long time, which
They don't
definitely,
have it anymore.
right, of course, because they realized they messed up huge. So can you comment on that, Nick? Maybe if that's way too far left field, let me know. But I was just
What
wanted to
about Chinese real estate buyers? Is that what you want to ask about, or just China's economy? Because
China in
China's
general.
economy hasn't been doing that well the last few years. They're putting in a bunch of fiscal policy measures to try to stimulate their economy
Uh-huh.
because they had too much debt, and their housing market makes ours look affordable. Like the
Interesting.
like the average house in like a city like Shanghai trades at like 30 times wages. Like imagine
Oh,
like having rents and and housing and buying condos the same prices as here in Orange County, but the average wage there for a college grad is instead of like 4 to 6 thousand a month like it is in the US, it's 1 to 2 thousand a month.
that is insane. Now, how did that happen though? Like, what caused that?
Because
Extreme
Chinese
concentration.
culture is like has your philosophy on investing. They don't like the stock market generally.
Okay.
And they're kind of restricted due to capital controls to international investments. And so they tend to go all in on housing because they can see
Mm.
it,
Mm,
it's real, they can control it, and yeah, it's all the reasons you mentioned. How and
interesting.
they have no property taxes.
Wow.
Whenever people complain, US is very expensive housing, I know this person has never left the US. They're
Right.
born and raised in a slum in Kansas, probably.
Hey, man, that's literally
It's
me.
like it's $400,000. Drew's from Kansas.
Yeah.
$400,000 US prices, average home, median home. 400. Canada is 800.
That's wild.
Well,
And
Canada has a more ridiculous housing bubble than
Yeah, they're stupid.
gateway
That's what
cities
it
in the
is.
US.
what's going on in
Like,
Canada? Well, why is that?
well,
They're
they
very
have
socialist.
well,
Oh,
that's not why housing prices are high. It's because Canada decided, oh, we're going to try to become a country of rentiers where we don't actually have to do anything and we can just profit off of hard assets and have people pay higher prices for the same amount of hard assets, whether it's their commodities in the ground through mining or oil, or through having a very generous immigration policy but not building enough supply. So you let in millions of people into Canada
I
every
see.
year,
I see.
and then they don't construct any new properties,
Yeah,
or they don't construct them nearly fast enough.
got
And
it.
so as a result, you have this major housing crisis. And Australia is going
Right.
through the same thing.
They're just
And
not building fast enough. We're having the same issue here in the States as well.
since
Yeah, but
2008, we haven't caught up.
Yeah, I get it. It scared off, killed off a lot of builders,
Yeah.
a lot of.
And then now with the interest rates, hard to kind of
but
build.
there are regions of the country where they do allow building in America.
Yeah, they're called red states.
Wait, say that again.
There
The
are regions
regions.
of the country that do allow building and
Oh,
development.
Yeah.
right,
And
right. That's where we
like
invest.
imagine
Actually,
like if California's policies on real estate was the entire country, or even worse, that's Canada and Australia.
I see. Okay. Yeah,
And
that's.
yeah, and also they have like the demographics who live there again also have similar biases against stocks. Like the Canadian stock
Mm,
market hasn't done very well for a long time. And a
interesting.
lot of it is also their currency is consistently going down too, which doesn't help matters. Like I did a video on my YouTube channel called Housing Isn't Expensive, You're Just Poor. And it's the idea
You know
that
what? I like this
We're
guy.
already getting along.
is the idea that basically real estate is expensive relative to people's wages, but
Yes.
if you wanted to buy a house in Newport Beach in ounces of gold, I can buy probably a better house for 1,000 ounces of gold today than I could um, in the 1990s.
Can you break that down? You kind of lost me a little bit. What do you
So
mean by that?
say for example, like in the 1990s, gold was $300 an ounce. So 1,000 ounces of gold can buy you a $300,000 house.
Mm-hmm.
Today, gold is, I think, like let me just check the
2000
exact
maybe.
price here. Is 26.91 an ounce, so a little under $2,700 an ounce. So
Okay.
1,000 ounces of gold buys you $2.7 million house today,
Interesting.
and that's way more than the official inflation numbers.
Well, Nick, that's a big. I like this argument too, but that's a big flaw. Do you know what? You ready for it?
What?
We don't get paid in gold bars, so they give you dollars and then they devalue the dollars every year. That's the
Just
scam.
keep printing more and more
Well,
of
yeah,
it.
investing in residential real estate. I'm not saying this for like commercial or apartments, but like single family homes is essentially you're buying inflation.
Yeah, yeah,
Yep.
you're right. But I'm saying like for people, the gold bars, they even do like with kilos of rice and like just commodities, like to see the house value. It is not gone up substantially, but the money that it takes to buy those commodities has gone up, right? So if your wages, which is getting paid in dollars, hasn't gone up to that, this argument wouldn't make a lot of sense because we just scammed everybody working
Well,
for
it does
dollars.
make a lot of sense. It's just that people's wages aren't going up.
That's what I'm
Yeah.
saying. So it is it's still expensive for them because
Yeah,
you
they're
didn't give
getting
them gold
poorer.
bars. Yeah.
That's the thing. It's like in terms of actual purchasing power, it hasn't gotten that much more expensive. It's just your income has gone down, and we since society doesn't allow pay cuts, we do them indirectly through money printing.
Yeah. So we figured out a way to literally scam the whole world is by making everybody adopt a paper currency system.
Mm-hmm.
And if you don't use it, we will say you need democracy and murder you. That's
Break
the
down a little bit what you're saying.
So basically, so if you work for gold, let's say you get a piece of coin, gold coin every, and everything is
back in the
taxed.
60s.
Yeah, 60s, whatever, or the 80s, whenever 70s, they took it off.
71 is when they took us off.
71. Is it Nixon? Did he do it?
Yeah.
Yeah,
Now,
Nixon did it in 71. Yeah.
so it kind of like your working for time, doing time for money went
Yep.
from time for gold to time for money,
Right.
but money is not real. They just
Right.
make it up.
Right.
And now they figured out, okay, wait, I could just do whatever I want with this and give whoever I want, and I just give you money, but I keep devaluing it.
Right.
So now you're just working,
You
like
keep
you said,
devaluing it by printing
by
more, you're
printing
saying.
more or just giving it to other countries or
Right.
whatever they want to do,
Right.
or so then now you're not really working for something that you're worth. It's
You're in a
just
losing game,
you're in a
essentially, is what I'm
losing game
hearing.
unless you figure out this is what they're doing
Right.
and you
And
start buying
then
stocks, bonds with Nick, or you buy real estate
why?
or buy gold coins.
Why does that? I want you to break it down for anyone listening. Why? Why are we buying real estate? Why does inflation actually help us and help guys like Nick?
Well, like I said, like well, the whole conversation we're having is, you're working, you're spending your time to do something, and they're giving you something that is meaningless. It just has
Right.
pictures on it. Literally buying like a Pictionary book, and then you're like, oh, this is really cool. I make so much money, but then they call somebody else and be like, yeah, print 10 times that, just
Yeah.
give it away, and they just devalued it.
But
So we have to exchange this money as quickly as we can.
right. So what I'm asking you to do is break down for the audience listening why we're buying real estate and why it puts us in the other
Well, yeah, you're
side.
protecting yourself against
Yeah.
inflation. And when
Yeah.
interest rates are low, you are basically getting paid to borrow.
Yes. Yeah. So for anyone listening, basically what I'm trying to fish out, I guess I just said it, is like that's one of the big benefits of investing in assets in general is they go up with they print more money, which they will always do.
Because it's the easier
Yeah,
way
but it's
out.
only
Yeah.
if inflation goes up slow enough for people not to notice.
Sure.
When it goes
Sure.
up too fast,
Sure.
asset prices come down. Like in the
Sure.
70s, real estate was flat, but
Yeah.
in inflation adjusted terms, it went down 30 to 50%.
Oh, really?
Yeah.
Wow.
Look at Canada's real estate market also, say from 1970 to 2000, had a similar phenomenon.
Interesting.
And then look at stock prices in 2022 when inflation got too high, we had a
Hmm.
bear market because the Fed had to raise interest rates to,
Yeah.
and that slowed down earnings, and also people couldn't buy as much stuff because their wages weren't catching up with higher prices, and that brought
Right.
down inflation adjusted revenues. So that's like when inflation gets too hot, that's the worst case scenario even for asset
Right.
holders.
Of
It's
course.
just you just got like if you have a moderate level of inflation, that is the best case for asset
Yeah.
holders.
Right. Right. No one
Yeah,
really
it,
notices.
it really benefits the guys who understand what's happening, and then you're basically investing into the economy. That's why you get the benefits
Hmm.
because they're using the dollars as a proxy, and they want you to do certain things. The
Right.
government, right? If you do those certain things, you can benefit. If you
Yeah.
just sit and complain about it, then you're not going to do anything.
Right.
Now, Nick, we want to close it down, but I wanted to ask you, there's a lot of stuff we talked about. It's pretty complicated. People will get kind of zoned out. It's very hard to follow and like follow through. You know what most people do is like, you know what, Nick studied too much. I don't know that knowledge. I'm not going to do anything. They go home and watch Netflix, right? So I want you to give us three things that if somebody's listening or watching us and they're like, bro, I got, I can save a couple grand a month, and I make, $80,000 a year. There's most people, and now I want to get into this thing. What are the three things I need to look for? Should I spend time looking at P&E ratios and looking to pick stocks, or should I buy real estate, or should I buy stocks or gold? Like, what should they do?
Yeah, if you have, I mean, again, for people who don't have like who are just starting saving and do not have a lot of who
Capital.
don't have a big nest egg already, the index funds will probably work just fine. Uh, but in terms of if you want to learn how to invest yourself, is that the question you're asking?
Yeah, like what should they look for? Like, let's say I want to like spend $500 a month trying to pick stocks because I like it. It's kind of fun. So what should they do? Like, is there something? Is a
Okay.
reasonable way
First
to
thing
do
you should
this?
look for is profitability.
Okay.
Like uh, and profitability and earnings growth are the probably the third. And then in order to make sure you don't overpay, a ratio I look at personally is I call it the PEG ratio, which is the price earnings divided by the growth rate. Like you shouldn't have a problem paying a high PE if the company is growing its profits fast enough to be worthwhile. So, however, you don't want to buy a company that has a high PE that's growing very slowly. That's the risk of imploding if interest rates go up or if the economy um, weakens more than something like that. So the other thing to also look at is debt. Does the company have too much leverage? Like a company with a lot of leverage does good when times are good, but in a down market, it goes down because the equity is just a stub on the debt. And then, as we talked about
Yeah.
before, the debt holders get paid first.
Yep.
So I look at it as profitability, earnings growth, make sure I'm not overpaying too much for those
Sure.
two things, and then I check leverage levels to see if
Nice.
they're sustainable.
But Nick, if that was just,
And it's
let's
not that
say,
simple. There's always a reason why. You have to look in and figure out why something is the way it is. Because if it was that simple, you can just hire ChatGPT to pick your stocks for you.
So there's always other nuances that
There's
are
always other
factors. Yeah.
nuances.
Yeah.
If
but
there
you know,
wasn't, I would be out of business.
Sure. Sure.
if that was the case, then like we would have not picked Tesla and Amazon. They were not making money for a long time, right? So what did they have
Amazon
that,
was making money in terms of free cash flows.
but they were just
They
reinvesting it?
reinvested a lot into the
Yeah, I see.
company, but they were generating cash. Tesla is more just a meme stock. You can't really use the
What
laws
does
of
that mean?
finance. It's just people like it because they're a fan of Elon and the
Yeah.
story. And
Yeah.
like the valuation and the fundamentals really are not a consideration of why the marginal buyer or seller invests in that stuff.
So you're basically saying it's inflated. It's
It's
overpriced.
emotionally, sentimentally driven.
Yeah. Yeah.
And
I was just commenting on that with the
I don't
Trump
really
thing.
touch it
Yeah.
because of that.
That makes sense. Yeah. It's a lot of emotional.
How about Netflix? Is that a good stock?
I'm not going to talk about my views on
What
specifics.
about Chill? Netflix and Chill. That's my stock.
That's a different stock.
Yeah, I'm not making any
Interesting.
calls bullish or bearish for specific companies.
Sure. Sure.
Publicly.
Was there anything else that you would advise, anyone trying to get started?
Yeah. First of all, I recommend just whether you invest in stocks or real estate, I just recommend just starting to save enough that you can start playing the game.
Got it.
Like I recommend if you can make it work without cramping your lifestyle too much, saving
Yeah.
25% of your gross paycheck
Yeah.
for investments. Um, and yeah, so because if you don't have consistent savings habits, and if you can't save that much, you need to figure out something in your career professionally to get your income
Yep.
higher enough.
Yep.
But if you can't consistently put that kind of money into them, it doesn't really matter because you're not going to have big enough of a balance that your asset appreciation is really going to affect your life.
So he's basically saying, step one, don't be poor. And in all seriousness, some tips for that, you guys, anyone listening who actually is poor, which by the way, I was very poor not long ago. Um, Something that I learned to do is to self-analyze and see where can I give the most value for the least energy output. Where am I thriving? Where am I excited to work? And I figured out what it is. And now, obviously educating myself on being a business owner and how to monetize. So basically what I'm really saying to everybody listening is value. Learn to
And
create
also the other
value.
thing as a business owner, you need to look at if you put that extra dollar into reinvesting in your company, is that higher than what you'd put in stocks or real estate?
Sure.
And if the answer is yes, just double down on what you're doing.
Yep.
And then also
Wholeheartedly
the
agree.
thing is when it comes to the difference between paying down debt and buying assets, you have to do a pre-tax interest rate versus an after-tax interest rate.
Can you
Like,
break down
so
what you're
say for
saying? You
example,
kind of lost me.
you have a loan that you have to pay that has 10% interest on it,
Okay.
and your tax bracket is 50%.
Mhm.
The real return of you paying down that debt is actually 20%, not 10%, because you pay down that debt in after-tax dollars, assuming it's personal, not business loan.
Okay.
And so if you have any debts that are say above a 3% interest rate, or you're probably better off paying down a debt than buying an asset.
Yeah, that makes sense. Okay. As a
What
general
if you're
rule,
paying
he's saying.
down debt with the asset? Oh, I got you.
uh,
Well, yeah. And then the other thing just has to do as a disclosure, like nothing I really am saying on this interview is like investment advice. Just always
Sure.
do your own research or contact an advisor if you have any specific questions for your needs.
Yeah.
Do
Love
we
that.
still run that disclaimer at the beginning of every episode? We have a disclaimer
I'm
for
pretty
that.
sure we do.
Yeah,
We have
you
like a
definitely need to for
pre-recorded.
this episode.
Yeah, we definitely will. We'll get you taken care of. Something else I want to make sure I didn't lose the listeners on is we're talking a lot about business owners and building your own business, which for me has been the answer and the way. But as somebody who has coached many entrepreneurs, I actually always tell people don't start your own business. You're statistically going to fail.
That's what my father said to me, and he's a business owner.
Exactly. But you know why? You know why I do that now? Because if I scare you away with just saying that, you weren't meant to be an entrepreneur already. You're not ready. I'm telling you, because you got to be an insane person. You got to be risk tolerant. You got to be able to handle those up and down swings with your business, like I'm handling right now. And you got to be able to roll up your sleeves and just be like, nah, I'm going to do this anyway.
Yeah,
And
that's
have
I'm
that bit of
totally
like,
with you on it.
yes. And so if you don't have that grit, and by the way, a lot of people think they have grit. You fucking probably don't. But if you think you do,
Get him, Drew.
love it. Then I say double down, figure out where you can provide the most value. Now, with those of you, most of you, I would say stay in your W-2, stay in your lane, stay in your job, figure out how to provide more value to the people that matter and provide, show up early, clock out late, the classics, all that, grind, 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 learn to provide more value, develop relationships. And here's a big tip that's helped a lot of my friends who are W-2s who are like, I just can't, I don't have enough money. I've got 2 kids now. I literally told my friend, if he's listening, Nick, he's probably not. Nick, you've been in this dead end job, that's like decent, and you've got 2 kids. You really are, your hands are tied. And some new chick just got hired and she's making more than you and she's got less experience. And he's like, he's pissed. I told him, well, why don't you play their game and go out and simply apply at a bunch of other places? He's like a property manager and apply at like 10 places. And just whenever they ask what the wage should be, put something higher than you're making, right? And sure enough, you got an offer letter. And I told him, and if you really like where you're staying, I get it. There's like some emotional, I'm attached to my coworkers, and he's that guy. He's just a really wonderful, fun individual. So I know he had that. So I was like, cool, bring that offer letter for a higher wage to your boss. And if they really value you, they'll meet it. Simple as that. And if they don't, you're respectful, like, cool. Well, then I've got to go over here. I have 2 kids to provide for. And he actually has done that now a couple of times. So you still have to be a little bit of a maker of your own destiny and to be a little bit entrepreneurial, even if you're a W-2 earner, because it's not your daddy's and your mommy's generation anymore where they could get one job and they could be taken care of for life because of, the company actually cared, which is rare now,
Yeah, they
unfortunately.
call it entrepreneurship.
Oh, interesting. There's a term for that?
Yeah.
Oh,
Wow.
nice. I've
Yeah.
heard of that term, but I didn't know this is what it was.
Nice.
Hey, before we let you go, Spearhead Advisors, is that did you start that company or do you work for them?
Yes. Yeah,
Oh,
I
nice.
started that
Cool.
company. I'm one of the 2 founding partners.
That's cool, man.
Nice.
How is that having running a business like that and also working on freaking all these stock stuff every day?
Well, yeah, I mean, it's a challenge. I think the business side, honestly, is harder for me than the research side because I've less experienced in it and my personality is more naturally introverted.
Right.
So, like having to go out there and do business development and all these kind of things is harder for me than diving down into the research.
Well, then my advice to you would be to, like what I was just saying, is double down on your strengths. Like hopefully you partner with somebody who has that quality where they love to go out and they love to bring in the capital or whatever it is. Something that's worked out for us is we have that. We have a very similar goal of just like crazy, goals of like in another level compared to most of our peers. And we're very different people, like
Yeah,
super
that's kind of how
numbers.
we've handled it on the investment side. I'm handling more of the equity and derivative side, and my business partner is a special expert in fixed income and bonds.
Nice. Okay. I love that. So you've got that nice little balance. That's great, man. How
Yeah.
can people get a hold of you? I want to watch your YouTube channel,
Yeah.
subscribe, hit
Yeah,
us
you
with
can
all those
find my
things.
YouTube channel, Analyzing Finance with Nick. I
Okay.
recommend subscribing. You can go to my website, nickpardini.com,
Okay.
and you can fill out the contact form if you have any specific questions for me.
Nice.
Um, and you could also join my Substack, which is Nick's Present Value, nickpardini.substack.com are
Got
probably
it.
the 3 best ways you can reach out to me.
And again, Substack what is
It,
Substack?
it's like a hybrid between like a blog and a mailing list platform.
Interesting. Okay. I'll have to check that out.
I use it
Okay.
as a way to like inform my followers updates on things, whether I'm doing on the YouTube channel or my
Okay.
business or
Got it.
meetups that I have in person with my subscribers,
Nice.
etc.
Very cool. Awesome. Well, I'll be following, liking, subscribing the whole bit, man. Thanks for your time, Nick. Look forward to seeing you out at maybe the next event, maybe sometime next week we can grab a little
Yeah.
dinner or something and go even deeper off the air, get
Yeah,
into the
thanks for
weeds.
having thanks for both of you having me on.
Yeah.
Of course, man.
Awesome.
We'll see you soon.
All right.
I don't know about you, but I definitely like to see 5-star reviews on any service or any product before I purchase. Please take a second to leave us a 5-star review, whether you're listening to it on Apple, iTunes, or Spotify, or whatever platform. Take a second, goes a long way, helps us a lot to grow the channel, and thanks for listening.